Good afternoon, and thank you for joining us for our TPN Tax Talks webinar, Don't Screw Up Your S Corps. I am Gary Dehart, the publisher of Tax Practice News and host of today's super short 30 plus or minus minute webinar. Our speaker is Christine Gervais, but before I have her introduce herself and have a couple of housekeeping items to go over, and then we'll turn it over to her. For starters, this is not a CPE eligible session. It's only a 30-minute session, so no CPE. If you have questions, we ask you just to put them in the questions panel, and Christine will try to get to those as she talks, but certainly at the end. The recording will be available. It will be added to our YouTube channel, and I will put the link to the recording or to the YouTube channel in the chat once I turn this over to Christine. And I'll also put the copy of the slide deck into the chat as well. And those will both be emailed to you after the event. Probably really tomorrow, you'll receive an email with the information. And like I said, I'll put those in the chat. That's all I have. Christine, it is all yours. Thank you.
Perfect. Thank you. Welcome, everybody. All right, give me just a second here. We're going to share my screen and get our presentation started. So I'm pretty excited about this one. It's definitely a little bit technical, but super important. Of course, we're sharing the wrong screen. Let me just flip here. See if we can get everybody on the right side. Okay. There we go. Now, as Gary mentioned, I will keep both the chat and the Q&A windows open. If you have any questions throughout the presentation, please don't hesitate to interrupt. I will do my best to answer all of those questions live for you as we go. So I'll keep an eye on that. Gary has already posted the link to the YouTube channel in the chat as well. So you can, and perfect, the slide deck. So you can grab both of those in case you have to hop off, grab the recording, grab the slide deck. Awesome. Okay, so let's get started. Today we're talking about preparing Form 7203. This is specific to S corporations, although some of these rules and kind of tax planning considerations are also going to be things that you're going to want to think about from the perspective of members or owners of partnerships as well. So I'll kind of dive into a little bit more detail when we get there about what those considerations are and what you need to think about. For those of you who don't know me or maybe haven't attended one of our webinars yet, my name is Christine Gervais. I've had my CPA license for over 10 years. I am the co-founder of Epiphany Consulting Group. So essentially, we're a small tax practice as well. I provide a lot of education to other CPAs and white label tax preparation and tax planning services. So let's just dive right in today and we'll talk about why we're here. What is Form 7203? So this is directly from the IRS website. This is for S Corporation shareholders. Now, just for right off the bat, really critical note for you, I will reiterate this. This form is actually prepared and filed as part of your shareholders' individual tax returns. So this is actually not something that the S corporation is going to prepare. So that's a really important distinction, especially for those of you who might be preparing an S corp return where you are not engaged to also file and prepare all of the individual shareholders' returns. This is something that they're going to have to prepare and file as part of their individual returns. But a lot of us, especially if you're working with closely held businesses like I do frequently, we're usually engaged to not only prepare the corporation, but the shareholders' individual returns as well. So we're going to see the full gamut of how these requirements play out and what tax considerations we need to keep in mind for our clients when we're talking about these. It does not apply to partnerships. So I mentioned that already, that this is specific to S corporations, but we are going to talk about what other types of tax considerations you need to keep in mind when it comes to things like loss limitations, basis, etc. So this form is specifically for S Corp owners to figure out their potential limitation of deductions, credits, and other items that can be deducted on their individual returns. That is an extremely broad definition, and we're going to talk specifically about what that means and what items you really need to be cognizant of. So here's an example starting off on the form. It's pretty basic when we look at the beginning. The shareholder stock basis is the piece that is going to be really critical here. John, yes, go right ahead and type your answer right into that question and answer box, and I will just pay attention for that popping up and see if I can answer your question for you. So this, again, this is going to be filed as part of their individual return. This is a really critical piece, this shareholder stock basis. And we're going to talk more about what goes into shareholder stock basis, some of the things that you need to consider and talk about. This is going to kind of look very similar to our K1 to start here. But the basis is going to be what defines for us when we're preparing their individual return some of the answers to these other questions, like how much loss are they allowed to take, are their distributions potentially taxable as a dividend, etc. And then this debt basis, which we're also going to talk about in more detail. So again, debt basis, super critical to answering these questions about what type of limitation on deductions, losses, credits might be impacting your individual shareholders' personal returns, as well as that question around, do they have any distributions from their S corporation that potentially need to be treated as a taxable dividend? So this schedule is also part of this form. This is just the second part of Form 7203. And you can see it goes on. We have gain on loan repayment. There's a lot of different facets being involved here that you have to look at for each individual shareholder. So things to think about in terms of compliance, and actually one of the reasons that I thought that this topic was so relevant is because I think, well, for one, Form 7203 is a change from previous years. This came into place last tax season. So it's not new this particular tax season, but I think there's still a lot of non-compliance in terms of the requirements for filing the form. So this form has to be filed in any of the situations where either a shareholder is claiming a pass-through loss from their S corporation and or they're claiming there's distributions of cash or property that are coming through on the K1. So those are the two key components that you need to be looking for. Again, you could have a situation where you may not be engaged to prepare the S corporation return itself, but you could potentially be engaged to be preparing an individual return for someone who's receiving a K1 from an S corporation. And in those instances, you need to be on the lookout for those two possibilities of, hey, I need to now file Form 7203. So again, that would be if there's a loss coming through or if there's any distributions coming up on the K1. Those are two really critical indicators that this form needs to be filed. And the things that we're going to really have to pay attention to, as well as some of those other miscellaneous deductions and credits that may be limited, but the two areas that I think are going to impact the majority of taxpayers in this scenario is the taxability of S Corp distributions that they may not have thought about in the past, and the loss limitations that may not have been a consideration in tax planning in the tax planning process. And again, I reiterated here, this form is filed by the shareholders individually, not the corporation. So in the instance where you don't have enough basis, and that's why this form really digs into supporting not just stock basis, but debt basis as well, is if there's not enough basis to support pass-through losses being taken, if there's not enough basis to support the tax-free distributions, because as most of us know, distributions from an S corporation are not treated the same way as distributions from a C Corp. They are traditionally not subject to that double taxation and being treated as a dividend on the individual shareholder's return. So that is not necessarily true if those distributions are exceeding earnings and profits as well as exceeding the shareholder's individual basis. So that basis calculation becomes really a very critical component of figuring out the tax situation of each of these individual shareholders. And in an S Corp situation, you could have different basis for each shareholder as well. And so that's just something to start to keep in mind. So how this changed, David, are there handouts? Yes, thank you for asking. So if you pop into the chat, Gary has already posted the copy of the slides for you, and they will also be emailed out after the webinar, probably tomorrow. So you'll get a copy of the presentation slides. This is a change from previous years. So previously, this type of information was filed as part of the instructions to a shareholder's K1. So you would see those extra pieces of information behind the K1 that you would receive or that you would prepare, depending on whether or not you were preparing the S corporation or the individual return or both. And so this is essentially replacing those instructions. I'm just guessing, but my feelings on the matter are that the IRS moved more to this very specific form compliance because what they were seeing was most likely a lot of shareholders filing their individual returns and not taking these limitations into consideration, or preparers not having enough information to accurately take these limitations into consideration. You could easily see from a preparer perspective that if you are not receiving enough information from your individual taxpayer client to know what their stock or debt basis is in an S corporation, that you would have really limited visibility into determining what might need to be limited, what might need to be treated as taxable from a distributions perspective. You really need a lot of historical information from the entity itself to accurately answer these questions. So I think a lot of this was getting missed, especially with some of these smaller, closely held S corporations. It's also really critical to note that almost every piece of tax software sort of glazes over this. And what I mean by that is there's really no specific diagnostic warning in most of these softwares to prompt you to take a look at this. I have used a lot of them, and I think I've only maybe seen once or twice where a software will prompt you to just take a second look at losses being passed through from an S Corp or partnership, or actually, I don't think that any of them will prompt you to take a look at taxability of distributions. So that's just really important to note, that you're not going to really get like that sort of safety double check to remember to take a look at this from your software prompting you to do so. And there's a link right here. Again, we'll send out these slides so you'll have it, but the link right here goes directly to the IRS instructions for 7203. They've provided some more recent clarification on this form. So those are up to date, I think, as early as the last month or so for you. So things that we really need to take a look at in terms of planning and having these conversations with your clients and being aware of who this might potentially impact is we want to take a look at compensation versus dividends from a tax planning perspective. So I'll just give you an example. You have a small, closely held S Corp. You might only have one or two shareholders. Shareholders might be a husband and wife. This is pretty common. And they very well may be on payroll, but they're taking a combination of both payroll, W-2 wages, as well as distributions from the business. Now, especially over the last couple of years, we saw a lot of organizations experience some business losses that they maybe historically hadn't seen for a while. It's very likely that in this year and the years coming up, we're going to see more of that. Everything is more expensive. These businesses are up against inflation. So you might start to see some losses more frequently than you have in the past, which just makes this a more critical consideration to be taking a look at these things. So let's just say, you know, they're taking $100,000 a year worth of compensation. They're taking another $50,000 a year worth of dividends, where you can potentially get into some some trouble or potentially miss the taxability of those distributions is they might have historically had some losses for a few years in a row. All of a sudden, we have negative equity. There's no accumulated earnings and profits. There's no positive equity balance. The shareholders aren't putting more money back in. They're taking more out than is supported by the equity balance or is supported by current year earnings and profits. That's a situation where those distributions are potentially going to be taxed to them at the capital gains rate. So that is a situation where you could have an S Corp distribution potentially be subject to essentially being treated the same way a dividend would from a C Corp if we don't have enough basis for that individual shareholder to support that distribution being taken. Because remember, the point of the tax-free distributions from an S corporation is that the tax has already been paid on that accumulated earnings and profits. If we're taking beyond that, that is really going to be treated as a taxable capital gain, essentially, from the organization. So that is where having accurate records of what makes up a shareholder basis is going to be extremely critical. Or taking a look at, is this a year where we need to have the owners shift more of what they're taking in distributions to be treated as compensation so that they're prepared? There's been withholdings on that. I don't know the answer to that. That is a very individual specific tax planning situation. You could have shareholders in a higher tax bracket that would prefer to take more of their income as dividends because it's taxed at a lower rate. But you really have to be prepared to have that conversation with your S Corp owners because it is a tax situation that they may not have found themselves in the past. They may have taken distributions for years and not had any of them be taxable. And again, accumulation of circumstances, all of the sudden we have a situation where these dividends may be taxable and we need to prepare them for what that might look like. If they need a shift in compensation, if they're fine with that capital gains rate, that's a really specific to each individual client. Yes, Richard, the handouts are posted right in the chat box and they will also be emailed out to you. So those types of tax planning considerations are obviously very individual to each client. Where you also have to start looking at what you have available to you from the preparer perspective is whether or not you have accurate enough records to rebuild shareholder basis or to answer any questions about shareholder basis. So again, being in this field for quite a while, I think that most of us have come across the situation where you take on a new client or you take on an existing business that has been operating for a while. They might not have had the most ideal historical records. You might not have access to tax returns all the way back to the beginning of time. You could, at any point in time, take on a tax return that just really doesn't give you all the information that you need to rebuild shareholder basis. And remember, we're talking about more than just stock basis. So this is more complicated than just what has the S Corp earned versus what has the S Corp lost versus what has the shareholder taken out versus what has the shareholder taken in. We also have to consider that debt basis. And so that could mean a bunch of different things as well. Has the shareholder taken loans? Has the shareholder given loans? All of these things are going to play a role in rebuilding that basis calculation for the purposes of us answering these questions on this form as to whether or not losses are limited, deductions are limited, distributions are taxable. So that's certainly a consideration that you don't want to have to be making in the middle of tax season, even though here we are in the middle of February, we're kind of well underway. So you want to start thinking about that now. How many S corporations or S corporation shareholders are you preparing tax returns for? That might be missing some of these components that might make it time consuming and difficult for you to try to analyze this and answer some of these questions. Most importantly, when you're preparing the shareholders' individual returns, how many of those do you have good basis work papers for, where you feel really confident in your ability to accurately prepare Form 7203? Or how many of them do you need to start going back to now and rebuilding those historical records so that you can confidently prepare this form? And then, as I mentioned, you want to start being able to identify the clients that you might need to prepare for these changes. So again, a lot of them might not have great historical records. A lot of them may have taken distributions for years. A lot of them may have had other preparers that have passed through losses that should have been limited that weren't, because again, I've seen all sorts of different situations. This is something that's really easy to miss when softwares are not prompting people, and it might not be something that it's very specific, obviously, to a very specific type of return and a very specific scenario. So it's easy for this to not be included in kind of general education for all preparers as they're going through the prep of their returns. So this is certainly something that could be easily missed, and you don't want your clients to be surprised by the change. And then consider just communication with non-client shareholders. That means that if you're preparing an S corporation return where you are maybe not engaged to do the tax preparation for all of the individual shareholders, just maybe out of courtesy, considering some communication in terms of this form is required. It's probably going to be a great value add service, even something you could potentially charge for if you do have all the S Corp records, to make sure that you are keeping track of all of that basis information. Even if you're not preparing the individual returns, it's likely that it's going to be requested from you. So just kind of start thinking about those considerations. And then preparing your team. So making sure that your team of preparers is educated in this respect at the very least, to know that when they're preparing an S Corp tax return, and or if they're preparing a 1040 that has a K1 coming from an S corporation, that they want to at least take the extra second to go through these sort of list of considerations and figure out, does this owner need to file 7203? For this S Corp, are we preparing any of these individual returns? Just what other considerations do we need to take a look at? So just taking that extra minute, knowing that they need to when we're preparing these types of returns. And then I highly recommend that you take a look at your fee structure for S Corp and then S Corp owner preparation. This is time consuming, as I'm sure many of you can start to tell. If you have to rebuild historical basis, if you've got to slow down and do all of this extra analysis to make sure that this form is filed when necessary, that it's filled out properly, you could easily see how your historical fee structure, not taking these components into consideration, is probably not going to cover the time that it would take to actually be compliant with this form and its requirements. So starting to take a look at, do you need to charge some extra fees for S Corp preparation or for 1040 preparation when you have an S Corp K1? Again, I don't know the answer to that question, but I do know that this process is more time consuming than it has been in the past. And so that probably is going to merit just us taking a look at, are we charging the right amount of money for prep in these scenarios? This is for, yes, Richard, this is for IRS Form 7203. I'm not sure if you're specifically what your question was related to it, if you want to clarify. Okay. Yeah, so you couldn't find it on the IRS site. And when you get the copies of the slides, the link to the instructions is right in there. You can also just Google Form 7203 and that pops right up on the IRS website for you. So I'll pause here for just a second and just see if there's any other specific questions regarding anything that we've gone over so far. This is definitely a lot of information. And again, like I said, In terms of what I'm seeing in the industry, this is really an area where I feel it hasn't been prioritized in terms of education because it's so specific, but it is going to impact a lot of taxpayers. And I think it's going to impact a lot more individual returns than maybe some of us have anticipated for the reasons that I mentioned. And it's not on everybody's list to make sure that we're keeping historical basis records, especially when you're bringing on new clients and things like that. So this is really important for us to just bring to our attention and start thinking about. You don't want to get into a situation. We only have a month left before these S Corp returns are due. And you don't want to get us into a situation in the middle of busy season where you're scrambling to try and find some of this information to keep your clients happy, which I think now is also a great time to have some of those conversations with your 1040 clients that might be impacted because they're receiving a K1 from an S Corp. Regardless of whether or not you prepare the S corporation, if you know that you don't have historical data, might be a great time right now to talk to them about potentially extending your return to make sure that you can rebuild that historical data and that you are going to be able to accurately file that form. Okay, awesome. So feel free, I'm going to pop to the next slide and just kind of go over, our best practices, next steps. But if there's other questions, please feel free to just continue to pop them right in that question and answer box or in the chat. And I'm happy to continue answering questions for you. So what can you do in terms of next steps? I love any form of organization to help keep us on track. I would start a list of both S corporations that you prepare, as well as individual tax returns you prepare that receive a K1 from an S corporation. So again, a lot of times, especially in our practice, being a small tax practice, we're doing everything. So we're doing both the S corporation as well as all of the individual shareholders, but not always, right? Sometimes those individual shareholders have other preparers, et cetera. But I would start a list of all of my S corporations as well as all of my individual tax returns that we prepare that receive a K1 from an S Corp, especially those individuals. And then you can use that list to start going through and reviewing which entities you might have historical basis information for, which entities you might have existing historical basis work papers for. And if you don't, you'll be able to start a list of which ones you need to recreate. So that will give you a great foundation in terms of, okay, here's my project. These are the list of taxpayers, tax returns that we need to start doing recreation of basis work papers on now. And remember, that includes debt basis, so that you have it available to you if and when you need it. So that is a great project. Also a great project for maybe some of your younger staff. If you know that you have the information, but a basis work paper isn't prepared, to have them learn how to prepare that basis work paper by going through the historical information. That's a great way to kind of learn about the components of basis, but definitely a project you want to start taking a look at and getting out of the way. And then I highly recommend updating those basis work papers annually going forward, as this form is obviously going to be required every year. Looking at historical compensation versus distributions and comparing to basis. So especially if you have shareholders that typically take larger distributions or take distributions that are fairly close to also what they're taking for compensation, that's a great tax planning scenario to start to take a look at now. Again, a huge opportunity for value add service. If those clients are not currently paying you for tax planning and consulting, that's a great intro to a conversation to say, hey, I think we need to look at this in a little bit more detail to make sure that you're not going to accidentally be subject to double taxation on the distributions that you're taking. Let's run some numbers. Let's make sure that you're taking the right split between your W-2 compensation, your distributions, and that we're analyzing this scenario. And then again, discuss this updated filing requirement with your clients that might potentially be impacted. All of my clients always tell me that You know, it's not writing the check to the IRS. That's the huge bummer. It's writing the check when they weren't expecting to. So the best thing that we can do as providers of the service is to do our best to make sure that they're not surprised. So just giving them a little bit of a heads up, those clients that may be impacted, to let them know that you're working on it, that if they want to have a more detailed discussion, that you're available for tax planning to really dig into how this might specifically impact them, is a great way to add that value and to let them know that you're on top of everything. And then here's my contact information. So if you have any follow-up questions after the webinar, please feel free to reach out to me. My email, our website is up for you. Again, as Gary mentioned at the beginning, the slides will be emailed out to you. So you'll get a copy of the recording of both the webinar and the slides probably sometime tomorrow. And if you haven't done so already, you can also grab the link to our YouTube channel right in that chat box, as well as a copy of the presentation that's already in there for you. The YouTube channel also has historical recordings of all of our previous webinars. So if this topic was interesting and you're looking for more, we do these little tax bites once a month where we do a half an hour of quick education for you. And there's a whole plethora of them in there for you on other topics. So I'll just leave the question box open for one more minute. Donna, the YouTube link is right in the chat. So I will copy and paste it back into the chat again. And Gary's usually really good, and we'll also send that out in the email, the follow-up email. So if you go right into the webinar chat, it's right in there for you. And I will answer it here as well so that you have it. Awesome. Okay. Give it about 5 more seconds just to see if there's any other last minute questions that you want to squeeze in there. Richard, I'm really glad that you love the YouTube channel. That makes me happy. Perfect. All right. Doesn't seem like we have any other questions. So thank you all so much for being here today. Very much appreciate it. Hopefully this was helpful. And keep your eyes open for the follow-up email with the slides and the copy of the recording.
All right. Well, thanks, Christine. Sorry, I think I know how to do this by now. Appreciate it. Certainly appreciate all that info, and certainly wish everybody a wonderful tax season.